Hello and welcome. In this video, we will learn how the price of an IPO of a running company is set. Okay? And for us to learn this, I'll take two cases. So case number one is the one that we have already learnt about. So I'll quickly recap it. Alright? We have two friends who want to start a company or an industry or a factory which manufactures coconut oil. The people who start the company are called as promoters. Now, they have calculated that they need 10,000 rupees to start the industry. Person A, this is the person A, has 4,000 rupees and says he want to contribute to the company. And person B has rupees 2,000 and he says that he will give it to start the company. So they need 10,000 rupees, they pool in 6,000 and still 4,000 is required to start the company. Okay. Now, they go to the bank and ask for the loan. And the bank says that they can give 2,000 rupees, maximum of 2,000 rupees with some percent of interest, and whatever money they take from the bank is called as debt. So now they have 8,000 rupees and 2,000 more is required. So what they do is they split the company into 4,000 shares of 2 rupees each. Now this price is arbitrarily set by the promoters of the company. Okay, there are no set rules to set this price. Okay, and after they split the company into 4,000 shares, person A and person B keep, or promoter A and promoter B keep 4,000 and 2,000 rupees worth of shares to themselves, which is 2,000 and 1,000, and rest is offered to the public through an IPO. Okay, so 1,000 shares are bought by the public and they get their 2,000 rupees, which adds up to 10,000, and then they start their company. Okay, so this is the first case which we have already learned about. Now we'll take the second case. All right, same case where they want to start an industry, they need 10,000. Person A pools 4,000 or gives 4,000, person B gives 2,000, 2,000 is taken from the bank and they need 2,000 more. Okay, now instead of splitting the company into 4,000 shares, they split the company into 3,000 shares. Alright, instead of 4,000 they split it into 3,000, and promoter A or person A keeps 2,000 shares and person B keeps 1,000 shares. So 2,000 plus 1,000 is 3,000. So entire equity is owned by the promoters now, or 100% of the shares is owned by these two promoters. They do not go for an IPO. They do not sell the shares to the public. They do not offer it to the public. Okay. So it is A and B who own entire shares of the company and the public doesn't have anything. Alright. So now the company is started using 8,000 rupees capital. They needed 10,000 rupees. They get 8,000 and they decide to start using 8,000 only. Maybe less machineries, less workforce or less production. Okay, so they start using 8,000 instead of the 10,000 and there is no shares to the public. Okay, so this is the second case. Now they start the company and over the next 5 years they work very hard, the promoters work very hard to establish the company, to sell their product, to market their product, and after 5 years, the company is in profit. Okay, company is in profit. Now, the profit is reinvested into the business after taking dividend and paying interest to the bank. Now, whatever profit they get or they are getting in their business, they keep some of it to themselves. Why? Because they have invested 4,000 and 2,000, correct? They have invested 6,000 and so they are keeping some part of the profit as dividend to themselves. We'll learn about dividend later in detail. Now, just know that it is a part of profit which the shareholders keep for themselves. Okay? And then they have taken 2,000 rupees loan from the bank, correct? So they have to pay interest every year. So from the profit, they pay the interest and they maintain the loan. So they do not want to repay the entire loan for whatever reasons. So they keep on paying the interest. Okay? And remaining money is reinvested into the business. Okay? Yes. Now, the worth of the company is 18,000 rupees. Okay, after 5 years, the worth of the company is 18,000 rupees. So, how much was it before? It was 6,000 rupees. 6,000 rupees plus 2,000 rupees loan from the bank. So, now it is 18,000 rupees plus 2,000 rupees loan from the bank. So, 6,000 worth has become 18,000 now plus the bank loan. Okay. Next, the shares cost rupees 6 each. Initially, when they split the company into 3,000 shares, it was priced at 2 rupees each. Okay, 2 rupees each. And now, after 5 years, due to all these profits, the price of a share is 6 rupees. Now, where? In the account book or in the book or on the papers. Okay, because they are not trading it, correct? The shares cost rupees 6 each in the book of accounts. Alright? Yes. Now they want to expand their company. They want to build a bigger factory, or maybe they want to build more factories in different cities or different states, or maybe they want to export their product into other countries by producing larger amount. Okay? Or in simple words, they want to expand their company. And to expand their company, they need more money. And so what they do is, they decide to create 1,000 shares and offer it to the public through an IPO. So now they are deciding to go for an IPO. So in case 1, before starting the industry, they went for the IPO. Now in case 2, the industry is up and running. It is already established. They have clients, they have business, they have profit, and now they want to expand their company, and to expand they want money, and so they are going for an IPO. Okay, so this is case 2. Now the question comes, at what price will the share be offered to the public in an IPO or in the IPO? See, in case 1, through the IPO, shares were sold at 2 rupees each, correct? So promoters kept the shares by buying it at 2 rupees each. The public also brought it at 2 rupees each. But now, in this case, we want to decide the price of the shares that will be offered to the public. Now, why do we want to decide the price? Because in case 1, the industry was not started. It was not operational. So, the investor or the public who want to buy the shares through an IPO, had a doubt in their mind whether the business will run, whether the business will be successful, whether the product will sell, whether they can make it in the market, so and so. And this is why it was offered at 2 rupees, the same price in which promoter also bought it. But now in second case, the company is already established, it is already in profit, it is already running, they have clients and so on. So now they cannot offer it at the same rate of 2 rupees each. And so they have to decide upon a price. How do they do it? Let us see. Now, face value is 2 rupees. Now, what is face value? Face value is the value of the share on a share certificate. Okay. So when you buy a share, you get share certificate. Whatever price is on the share certificate is called as face value. Alright. Or whatever price the share was sold initially is the face value of the share. Okay. Now when we deal in the market, we do not have to worry about the face value. Alright. Because we do not take this into consideration. It is book value and market value which matters, which we will see later. Alright. So face value is rupees 2. That is the price at which the shares was offered initially. It was brought by promoters, correct? So 2 rupees face value. Now in the second case, if they want to offer shares in an IPO, they will offer it at a price which is equal to this 2 rupees, which is face value, and a premium which has come to 14 rupees in our example only. So what is this premium? What is this premium and what does it depend on? Now this premium depends on many factors. Alright. Now what are the factors? Book value difference. Rupees 6 minus rupees 2, which is rupees 4. What is rupees 6? Rupees 6 is the price or worth of the share right now. I told you that the worth of the company is 18,000 plus 2,000 in the previous slide. 18,000 plus 2,000 and worth of each share is 6 rupees each. Correct? So 6 rupees minus 2 rupees. What is 2 rupees? Face value. So 6 rupees minus 2 rupees is 4 rupees. So 2 rupees plus 4 rupees. Okay? 2 rupees plus 4 rupees. Next, brand value. So the industry or the company is already established. It has a brand name and the brand name has a value. And so add 5 rupees more. So 2 rupees plus 4 plus 5. Now, the company is already established or the business is already established. It is up and running smoothly and they have loyal clients, buyers. So for that, extra 2 rupees. So 2 plus 4 plus 5 plus 2. And then future prospects. That is, in the future, the company will do good. Alright? Because the promoters are confident. They have demand for their product. And they are having loyal clients. And they expect their company to grow. So in the future, they are expecting their company to grow. And so add 3 more rupees. So it is 2 plus 4 plus 5 plus 2 plus 3. Okay? So it is totally 16 rupees. Or 2 rupees is the face value. 4 plus 5 plus 2 plus 3 is 14 rupees, which is premium. So add 2 plus 14, 16 rupees. At 16 rupees, shares will be offered to the public in an IPO. Okay? Shares will be offered to the public in an IPO. Okay? So this is how the IPO or an IPO is priced. Now, whatever I have explained here is hypothetical. Okay? This is not the actual case. In reality, we have people at high position in a company to calculate what the premium will be or how much extra they have to pay. Okay? They have complex formulas, they have complex process through which they decide the premium which will be added to the face value and which will be offered to the public. This is just an example to make you understand what are the things that decide the premium. Okay? So in case 1, the company was not operational and so it was offered at the same rate to the promoters and to the public at 2 rupees. But in the second case, the company was already up and running, already established, having loyal clients, brand value, future prospects, and so it will be offered at a higher rate to the public through an IPO. Okay? In the first case, before starting the business, before starting the industry, IPO was offered. In the second case, the company was running and to expand their company, the IPO was offered. Alright? Yes. Now, the question comes. You as an investor, should you apply for an IPO or not? To answer this, we'll have to learn few more things, which we will learn in the next video. Alright? So till then, take care and thank you for watching.